Good morning, ladies and gentlemen, and welcome to the Economic Outlook Seminar. I am Cheng Lu, President and CEO of Cathay Bank. This marks the 8th year that Cathay Bank has collaborated with UCLA Anderson Forecast. During these uncertain times, we will continue to keep our clients and community informed of the latest economic developments and their potential impact. Today's seminar features Dr. Jerry Nicholsberg, Director and Senior Economist at the UCLA Anderson Forecast, who is highly regarded for his contributions to economic modeling and forecasting on national and regional economies. He will be sharing his insights into the global economy under the current administration, discussing emerging trends in international trade and supply chains, the latest developments in China's economy, and the current state of the U.S. real estate market and regional economic performance. Without further ado, I will now turn it over to Dr. Nicholsberg.
Thank you, Cheng, for that nice introduction. Always a pleasure to be here with our friends at Cathay Bank and with all of you. And so what are we going to talk about today? Trade wars and economic policy. These are uncertain times, and that uncertainty has been heightened because what we're seeing coming out of the U.S. government is a whole host of policy changes that are designed really to transform U.S. economic structure, both internationally and domestically, and they're all happening at once. And this is something that we have never seen before in history. We've seen big changes, but not kind of this aggregate, this cumulative change across many different sectors. And so, in some sense, we don't have the empirical data to evaluate this in a tight way. What that means is that there's heightened uncertainty, and there is a need to look at data to kind of avoid the pundits and really think about where is the economy going and how is that going to impact us. So as you see on the first slide, we have an illustration, a picture that illustrates the trade wars. So let me begin just by quickly going through what all of these policies are and some thoughts on them, and then we'll turn to the economic outlook. So first, tariffs. Tariffs are, of course, the big issue. They change every day, and that's problematic. But I like to separate the tariffs into two kinds of tariffs, or really three, but I have two here. Penalty tariffs. And penalty tariffs are being applied to countries because of a thinking that those countries have engaged in unfair trade practices, whether that's imagined or real, is kind of beside the point. What's important about penalty tariffs is that they are likely going to go on and stay on. A second kind of aspect of this is national security tariffs, and those would be ones, for example, on steel and aluminum, to try and create a more robust U.S. steel and aluminum industry. So those are tariffs that we can expect to go on for the long term. And then second is negotiating tariffs, tariffs that are being put on for purposes of negotiation. It's an opening salvo in negotiation. I have here Mexico and Canada. I also put Denmark kind of just for fun because Denmark has been threatened with big tariffs if they don't negotiate over the ownership of Greenland. It's important to note what the empirical data is. We haven't had many instances of an increase in tariffs in the US. But in 2018, during the first Trump administration, tariffs went up. In 1930, we had the Smoot-Hawley tariffs, which were of the same order of magnitude as the tariffs that are being proposed and put on today. In both of those cases, measures of the amount of dollars paid to the exporters to the U.S. pre and post tariff have shown that the imposition of the tariffs did not reduce the dollars received by the exporters. And that means that the entire cost of the tariffs in 2018 and in 1930 was a tax on the U.S. economy. And this is really a sales tax. For those of you who are in California, you know that we have a sales tax, but it's only on goods and it's only on some goods. So that's a tax on goods by their functionality. A tariff is a tax on goods by their origin, but it's a sales tax nonetheless. And sales taxes generally get passed on to consumers, although maybe partially absorbed by the retailer. The second kind of important aspect of this is that there has been disruption in markets because of these negotiating tariffs. They're on again, off again. And what that means is that businesses can't predict the cost of the inputs to their production process. And so that kind of freezes them to wait and see what happens. And that's a reduction in investment. It also can be a reduction in consumption, and those are going to affect GDP. And then we're going to talk later about the implications for California. Next is immigration, and the Trump administration has promised to have the largest deportation in U.S. history. That would mean over 1.3 million people this year. They are way behind on this, and that's because of logistics and legal challenges, and quite frankly, diminishing returns in finding people to deport. So the rate of deportation today is about where it was in the Obama administration. So when does deportation get up to that 1.3 plus million per year? That's an open question, but it's going to hit agriculture, non-durable goods manufacturing, healthcare and social services, leisure and hospitality and construction. And again, we'll talk about the implications for California. And then, the kind of the third really important thing for us to keep in mind is this chaos in government. We have layoffs, but the layoffs might not be legal. So maybe layoffs, maybe not. That really interrupts the function of government because people don't know, first, if they're going to have a job, and second, who they report to. Policy clarity, what is the policy vis-a-vis a reduction in government employment, and we really don't have any evidence of what the economic impact is, but we do know that when you have a government that is not functioning well because of disruptions in government, that does not give you a stable economic environment, and that has a negative impact on economic activity. And then just a couple of other things before we really turn to the outlook. The first is that immigration policy is reducing the workforce, even though deportations are not at the levels previously promised. People are staying home from work. They're earning less, and therefore they are demanding less. And so this, really has an implication for firms. If they see slack demand, they're not going to be hiring. They're not going to be expanding their businesses. And then finally, we're not really in a position to have much clarity as to what the impact of all of this is going to be on debt. So far, it looks like U.S. debt is going to continue to go up faster than government revenues. And exchange rates, there is pressure on the dollar, and the dollar has been depreciating. Okay, so that is 10 minutes on the background. Let's go to the U.S. macro outlook. We did this outlook in March, and so I want to tell you where we're going to be approximately in June, though things could change pretty rapidly. You see here in the blue on the left-hand side of this graph, that is the 3% economy that we were in 2024. Because of deportations and promised tariffs, we have, more or less a 1.5% economy, going down to a 1% economy. And now our view is that there has been a sufficient amount of disruption. Tariffs are higher than they were projected to be, and we're going to be around 0.5% economic growth in 2025 in the current year and going into 2026. And when you think of an economy that's only growing at 0.5%, it doesn't take much to push it over into the negative territory. So we definitely have a risk of a recession. And what we've done at UCLA is we've called a recession watch. That means keep looking at the data because we really are close to a position where the economy could be contracting for a number of quarters in 2025 and again into 2026. The unemployment rate is going to be going up. Part of that is due to this slack demand. Part of it will be due to the fact that deportations are going to reduce the workforce, and therefore complementary workers are going to find themselves unemployed. And part is due to the fact that prices are going up because of the tariffs. With prices going up, consumers are going to be squeezed, particularly when prices go up with respect to food and other essentials. And that means there's going to be slack demand for other kinds of manufacturing and services. We have the unemployment rate going up here to about 4.6%. It could well go higher to the upper fours and close to 5% this year. And then I want to point out that we were in 2023 and into 2024 at unemployment rates that were 3.4, 3.5, even 3.6%. That was an overheated economy. We moved to a fairly normal economy of 4 to 4.2%. In March, the U.S. unemployment rate was 4.2%. So far in 2025, we have continued with the inertia from 2024, and the economy looks pretty good. Labor markets look pretty good. And our forecast is that they're going to deteriorate as we move through 2025. But because there's a lot of inertia in the U.S. economy, maybe by not as much as if all of this happened on a weak economy, as it did in 1930 with the Smoot-Hawley tariffs. The graph that you see here is inflation, and so the solid line, blue for actuals and yellow for the forecast, is core consumer price index. And our original forecast was that to be going down. We are increasing that because the level of tariffs and the spread of tariffs is much greater than we and maybe anyone else predicted. The dotted line is wages, and you see that wages are going up because we have a labor shortage that's coming as our labor force is reduced. And the solid line is a 2% target from the Federal Reserve. I want to say more about that momentarily. But this is something that the Federal Reserve looks at when they are thinking about what they should do with respect to interest rates. This is inflation expectations. It's from the Michigan survey, and there are two lines here. Let's look at the orange line first. That's the 5-year ahead expectation on the part of households of the inflation rate. And if you notice, moving your eyes from left to right is pretty stable it's stable about 3%, maybe slightly below. And that was in 2022 and 2023 when inflation rates were actually much higher. This was, the real peak that the Fed was combating against. So inflation expectations were not unmoored, they were really anchored. But if you look over to the right, that orange line has now increased up to about 3.5%. It's increased even more. And in fact, the latest survey had it up at almost 7%. And then the 1 year ahead, which is the blue one, again, it's coming down with inflation coming down. Expectations are now, again, in this graph, we've got it going up to about 4.4%, just released this last week, another big bump in the 1 year ahead inflation expectations. So the Fed is seeing prices going up and expectations going up. why expectations are important is if people think that prices are going to go up, they're going to buy now, they're going to kind of increase the turnover. And that increase in the turnover is going to push prices up. It's going to indicate to firms that they can raise prices. And you get this kind of wage price spiral that's going to be going on that will spur inflation. And that leads us to the quandary that the Fed has. And so this is really important for interest rates. Will the Fed lower rates in 2025, 2026, and 2027? The markets think so. We are not so sure because the uncertainties are so large. There's a downside risk because the economy is going to be weakening. We just talked about that. There's going to be higher unemployment, but there's higher inflation and the unanchoring of expectations. The Fed has a dual mandate, and that dual mandate is full employment. We're going to be moving away from that, and price stability, and we're moving away from the Fed's target of 2%. So what do? In our forecast, we have them doing nothing, just keeping interest rates where they are. However, during the inflation that we just looked at in 2022 and 2023, the chairman of the Federal Reserve, Jerome Powell, the president of the New York Federal Reserve Bank, as well, John Williams, they both said that inflation was more important than unemployment. They didn't want to create a recession, but if that's what it took to bring inflation down to 2%, they were willing to go there. Have they changed their minds? We don't know. But if that's still their view, look for interest rates actually to go up, not go down. And we see that somewhat reflected in the 10-year Treasury bill over the last week or so. And so, finally, oil prices and we have this drill baby drill that we heard during the campaign. What you see here, the orange line is West Texas Intermediate crude prices, and they are down right around 60 to upper 60s, lower 70s dollars per barrel. The top line, the blue line, is U.S. oil production at record levels. And, when you look at oil markets, you really don't see oil prices going up. And oil extraction companies have been very clear that unless oil prices go up to, for example, $80 a barrel, they're not going to do additional drilling. They want less regulation, but that's not going to cause additional drilling. But our expectation is that petroleum prices are going to stay kind of right where they're at. And that's good news for the U.S. economy because oil, quite frankly, fuels the economy. There's one fly in the ointment here, and that is that there will be an easing of regulations for the exportation of natural gas to Europe. Natural gas prices in Europe are many-fold natural gas prices in the U.S. So naturally, natural gas producers are going to ship as much as they can to Europe to get the higher price. That means lower quantities of natural gas in the U.S. and higher natural gas prices for U.S. households and for electrical generating plants that have now been converted from coal to natural gas. So electricity prices going up, natural gas prices going up, and that is a headwind for the U.S. economy. So now let's turn to China. And I have three pictures here. One is housing. One is manufacturing and exports. And then the bottom right is infrastructure. These are the three problematic areas for China. Too much housing, which means too much investment in housing. Too much of the economy is oriented towards the building of housing. And so that obviously has to shrink. China's exports, China has been trying to increase their exports and continue with an export-led economy. They've been successful in South and Southeast Asia. With tariffs, going to be less successful in the U.S. now. And with that, a kind of a pivot to their other large market, which is Europe, they're going to find less success. So that's problematic. And China really has built all the infrastructure it needs. So it might invest in more infrastructure, but that's going to have a negative rate of return. So these are three really problematic areas for China, and the trade wars are just going to make it worse. So, what does that mean for GDP? You see two lines here. One is the official release, and kind of the latest that we heard is, well, China is grew in the first quarter of 2025 by 4%. The red is our estimate, and we have China really not growing much at all, a slight positive in the first quarter, and likely going into recession thereafter. So what's the difference between our model and theirs? The official data, even if it's collected correctly, is done with a different methodology than, say, U.S. GDP. And just going back to, for example, the infrastructure, that's going to be added in the Chinese national income statistics at cost. Housing is going to be evaluated at cost. In the US and Western GDPs, it's evaluated at market values. So if you're building housing today and evaluating it at cost, you're overvaluing it relative to its market values. And so if you think about the market value of the Chinese economy, it's down near zero now. And what are the other headwinds? Well, one is the debt keeps rising. This is total debt to GDP ratio. The top line is Japan, which has always had a very high debt because Japanese households are major savers. And what they do, instead of having higher taxes, is they save in the postal savings system, and the government borrows it. And so that's government debt. But that's rarely redeemed, and it's pretty much internal. Chinese debt has been going up, and debt to GDP ratio now exceeds that of the US. And if we break that down a little bit, here we have year-over-year growth rate of nominal fixed asset investment for major sectors in China. And you see the red line is real estate, which has gone negative. That's what we expect. But manufacturing and transportation infrastructure are still staying positive, even though the markets for those are diminishing. So we've got overinvestment, and there has been overinvestment for a number of years in manufacturing, in tech. And though China is trying to move up the food chain through increasing electric vehicle production, through heavy investment in AI, what you have there is a diversion of resources from where it's most productive to things that have a long lead time for having payoffs. And the other important aspect of this is the shift on the part of the Chinese government towards state-owned enterprises, favoring state-owned enterprises. In the latest pronouncements from the two sessions and from the previous plenum, China is looking to address the weakness in their economy with sort of now time-worn policies that have basically led to these imbalances. And that means that the Chinese economy is in for slow growth for some period of time. What's important to note here is that Japan went through, a similar kind of slowdown as it pivoted from an export-led economy to a more domestically demand-driven economy. And Japan has a declining population, But when all of that happened, Japan was a very wealthy country. That's not the case with respect to China. And so China is trying to pivot, at a time when, yes, the Chinese population has kind of remarkably been moved out of poverty into lower income and middle income. And to be sure, there are many, many wealthy folks in China, but China is not a wealthy country, and it is facing stagnation or very slow growth. So this is really problematic for the Chinese economy going forward. If we look at corporate debt finance, which is going to limit private sector growth, and private sector growth since the late 80s has been really the remarkable story of China's growth. On the left-hand graph, it's debt as a percentage of GDP, and corporate debt is in the green. And what you see there is corporate debt in the U.S., relatively small, but corporate debt in China is actually quite large, about double that. And so that is problematic. And with the weakness that we just talked about in terms of the Chinese economy, foreign investors are going to be less inclined to lend to the private sector in China. Not that there won't be some investment and some lending, but less inclined. And so again, this is another headwind for the Chinese economy. In order to pivot to a domestic demand-driven economy, like the US, like most Western economies, that kind of self-generate the growth as opposed to being dependent on external conditions, China has to have much greater domestic demand. So here you see on different scales, the US and China. And so on the left-hand side is GDP per capita in the US, and then GDP per capita in China. And then the middle block is disposable income. And in the US, disposable income is 3/4 of GDP. And in China, it's less than half. And then consumption per capita, which is 2/3 of GDP in the US, it's only 30%, less than 1/3 in China. So this is a big challenge of moving that 30% up to the point, not necessarily 2/3, but to the point where that's really generating sustainable economic growth. And I know that, in the policy pronouncements from the Chinese government, that this is a concern, that they would like to boost spending, but the Chinese consumer is a bit spooked by what's happening. And what happens there is the savings rates tend to go up. Right after the 2008, 2009 financial crisis in the US, we saw US savings rates go up, and the 68% actually drop by a number of percentage points as US consumers wanted to take defensive action, not knowing what was going to happen to the economy in the coming years. That's what's happening in China today. Chinese households similarly are saying, we see the data that we just discussed here, and we're not so sure we want to consume more, as opposed to making sure that we have the resources for tough times if, in fact, they come. And so we have this vicious cycle. We have tariffs, and that's going to result in lower export income. It's going to result in less manufacturing, and it's going to result in less employment. There's a negative impact on domestic consumption. That's going to be a negative feedback on GDP demand, and we get declining overall growth and a possible recession. So the question is, can China escape what's called the middle income trap? And that's when an economy gets to the point where China is now. It's a middle income country. Can they actually move up the food chain? Policy is more emphasis on state-owned enterprises to try and do that. Investment in high tech, but high tech means low employment. And so there's a very kind of fine line there with a declining labor force. That's maybe not so bad, but one does have to worry about where if the growth is in low employment areas, if it creates underemployment, and that creates a social stability situation. And we have no change in the safety net policy on the part of the government of China. And in the US, in the OECD countries, the safety net is one reason why people don't save as much. And China does not have the same kind of safety net, leading to that low consumption. So the question for China is, where is the pivot to domestic demand generating economic growth and income? And so let's talk about the risks to the forecast. And I've said, a lot of things kind of negative about both countries. The first is the size and the time and timing of deportation. So I want to talk a little bit more about that, turning back to the U.S. economy. Deportations are not kind of random events across the labor force. The deportations are going to be primarily in lower skilled activities. They're going to be concentrated in places like construction, where fully a quarter of the labor force is subject to deportation. Construction is a very important part of the economy. Fluctuations in construction have been associated with recessions. And, for purposes of the economic outlook, it doesn't really matter if the Trump administration reaches their 1.3, 1.5 million per year target of the number of people deported. What matters is whether or not people go to work. And we're already starting to see people in construction not going to work, because this is a good place for the Immigration and Naturalization Services to go and find a large number of people, right? So you go to construction sites, go to Restaurant Row, you go to healthcare facilities, and you go to farms. Once you've done that, then you have to start looking to the one-offs. But for each of those that I just listed, expect people to stay home. And as I said before, we're already seeing that. And that has a negative impact in two ways. One is they're not producing goods, and therefore they don't have the income to demand goods. And the second is that there's complementarities. So, for example, if half of the workforce that is putting up drywall in residential construction is staying home or being deported, then it slows down residential construction. If residential construction slows down, you need fewer of the other folks, people who have legal status, because you're just building fewer homes. And so you've got a real impact here. So that's one of the risks to the forecast. The second, more extensive tariffs and retaliation. We're already seeing that. The president put on these reciprocal tariffs, although it wasn't clear what it was reciprocal to. And those reciprocal tariffs were so damaging to international trade that they didn't stay on for very long. there's a promise to put them back on. But when you look at it, there are 80 countries. Can the U.S. negotiate over a 90-day period new trade arrangements with 80 countries? And I think the answer is no. So what happens? Do they go back on? Or does the Trump administration say we got what we wanted and therefore we're good? We'll just stay with the 10% across the board tariffs. It's an open question, and that's a risk to the forecast. We have geopolitical risk, and this is not insignificant because the Trump administration has indicated that they're going to, in one way or another, control the Panama Canal, in one way or another, control Greenland. And that is for geopolitical reasons, ostensibly. That opens up the possibility of other countries doing the same thing because it's in their geopolitical interest. And of course, we're talking about China and the United States. And so, China's interest in what happens in Taiwan, China's interest in what happens in the South China Sea are all relevant here. To what extent do these geopolitical forces really impact international trade and economies as the U.S. and China decouple, at least in some industries? And then back to disruption in federal government. We know historically this is a place where we have some data on the economic impact. It really depends on how long this goes on. So Elon Musk has said that he's going to be out by May and back to running his businesses. If the government comes back to functioning properly by then maybe this is a minor disruption. But if it goes on for some time, say for the rest of the year, then it could have a real major impact, not just in 2025, but also in 2026. And so that concludes sort of my formal remarks. I'd like to make a few more comments. In the U.S., we've seen healthcare and social services and leisure and hospitality be growth sectors and important growth sectors. And deportations and tariffs are going to affect both of those. And so the question is, where do we get growth in the U.S.? And, you saw in our U.S. forecast that we had 2026, late 2026, and in 2027, superior growth, almost 3%, not as good as 2024, but pretty close to that. What was driving that? And the answer is that in this transformation of the U.S. economy, we are going to see firms with labor shortages and wanting to find labor-saving equipment and software. In the tech industry, that's exactly what's being developed. If you think of AI and if you think of robotics and other technologies that are coming to the fore, we're going to see a lot of investment there because that is indeed a place where superior returns can be earned. And that investment is going to lead to productivity gains and really superior productivity gains. The new technologies will be adopted more rapidly because of the shrinking labor force and because of the tariffs raising prices. And so we could see actually, as we get to late 2026 and into 2027, real solid economic growth in the U.S. in spite of everything that's happening now. So the outlook is not all gloom and doom. We just need to get through this period of time in the U.S. Similarly, for China, the investment in new technologies, which I alluded to when I talked about the fact that that investment does not lead to a lot of increased employment, can also increase productivity and with that increased productivity, you can see greater income, greater output, and this may well be, as I think that the Chinese authorities think, the way out of the middle income trap, because as productivity goes up, as Chinese households have more income, they'll spend more, and that might be the pivot to more consumption. So I've covered a lot of territory without kind of a lot of depth here, because I wanted to leave quite a bit of time for your questions. And so I think now we'll turn to questions. So while we're waiting for the questions, let me make some comments about real estate and commercial real estate. So with residential real estate, with the labor shortages, we are not expecting a lot of new construction. We're not expecting a boom in construction. And so we're seeing, particularly in places in the Southwest where there was a building boom in multifamily housing, we're seeing absorption happening and those markets tightening. In California, we've had an unfortunate reduction in the stock of housing. And so there's going to be some pressure there for building new housing. So that's a place for investment opportunities. There is a movement of return to the office. It's been strengthened by the fact that the federal government has ordered a return to the office. Amazon has ordered a return to the office. And so while office markets still remain soft, they're starting to turn the corner. Retail has turned the corner, and we're beginning to see growth in rental rates, leasing rates for retail space, and some new retail construction. People want to be out. They want to be in experiential shops and malls, and so that's encouraging. Industrial space is a real question mark, because if imports are really coming down as a consequence of the tariffs, then we might not need as much in the way of warehouse space. And we've seen a pullback in new warehouse construction, particularly here in California, where imports from China and Asia come through the large ports of Los Angeles and Long Beach. But on the other hand, industrial space that's meant for manufacturing, so the building of factories, has been booming, and there's some indication that that will continue. So it's really sort of mixed. Now, there is one other part of commercial real estate which I think is problematic, and that is hotels and resorts. With the soft economy, with the fact that Canadian and Chinese tourists are not coming to the U.S., this is going to be an area that will be fairly soft until kind of all of this resolves and we get into probably 2027. So that's kind of a brief overview of what's happening with commercial real estate.
Do you think Doge is positive or negative for the economy, short term, long term?
I'm sorry, do I think what?
It's posted in the meeting chat. Do you think
Doge.
Doge is positive or negative for the economy? Yeah.
So that's an easy question, because it is negative, right? It is, what Doge is doing is it's looking at government agencies in the way that Elon Musk looked at Twitter and saying, let's get rid of a lot of people. And what should be done in order to achieve efficiency is to look at the agencies and see where productivity can be increased and the labor force, if possible, decreased. And so what we have now is no one knows if they're going to be fired. And if they're fired, they don't know if that's legal and they're going to be rehired. And that just causes government activity to come to a halt. So it's clearly a negative in the way it's being implemented, not necessarily the thought behind it, but it's unambiguously a negative.
Right. And the next question is the economic sphere is not just China and the USA. How is the rest of the world reacting and acting with all of these?
I think the rest of the world is in shock about the reciprocal tariffs, and you see kind of mixed activity happening. President Sheinbaum of Mexico is engaged in negotiations. Um, what is Canada going to do? The evidence is that exports from the U.S. to Canada are plummeting, including tourism, which is an export, beverages, and other exports. So that's going to be a negative for the Canadian economy. I think the world economy is going to grow much slower. Europe has been growing very slowly. Germany has had a negative growth in GDP, so a contraction. The largest export industry in Germany is automobiles, many of which come to the U.S. And with the tariffs on automobiles that are not manufactured in the U.S., you're going to see many fewer of those being shipped. An $80,000 luxury car coming out of Germany is now going to be $100,000. So that's going to very much have a negative impact, and so expect countervailing duties on the part of the European market, which is an important market for the U.S., Canada, and Mexico. On the other hand, what you're going to see in places like Brazil and Australia is an increase in exports to China. So China is a large consumer of natural resources, and these countries will definitely benefit. They did in 2018 through 2022 with exports to China, foodstuffs, soybeans, iron ore, etc.
How will the increased labor cost and servicing related charges impact the U.S. Economy?
So those increased costs are going to be a negative, and you can expect interest rates, commercial interest rates, to go up, which will be a negative. They have to incorporate the additional inflation, and so even if the Fed doesn't move or they move slightly towards easing, commercial rates are still going to increase. So you've seen the 10-year go to, I think today it's about 4.3. You can expect it to stay in the mid fours, maybe go higher. And so all of this certainly is a negative for the U.S. economy, for U.S. economic growth over the next 18 months.
Right. And the next question is, how do you see California real estate faring through this downturn, specifically industrial in LA? So many jobs need the port traffic, and that will be decreasing with the trade wars.
So, probably the larger threat to logistics is automation, and we're seeing increasing automation of warehouses. Will we see a dramatic drop in imports? Certainly not initially. A lot of the imports that come in through the ports of Los Angeles and Long Beach, and the port of Oakland, and the Puget Sound, for that matter, are inputs to the production process. And so they're still going to be coming in. They'll have a tariff. It'll result in higher prices. And when the U.S. economy starts growing again, consumers are going to demand additional goods, some of which will be imported. So we're not seeing evidence that there's going to be a dramatic decline in employment in logistics, and we're not seeing that there's going to be a dramatic decline in the number of imports. There will be a shift, particularly if the reciprocal tariffs don't go on. There will be a shift from China to South and Southeast Asia, and we saw that in 2018. So maybe it's not as dire as it might seem at first glance.
And the next question, how will this impact the banking industry, specifically for California?
Well, the impact on the banking industry, I don't have a lot of insight, and I rely on our friends at Cathay Bank for this. Higher interest rates, less demand for loans, but higher interest rates and a positively sloped yield curve, which we're seeing now, means that there's going to be a greater spread between short-term borrowing and long-term lending, so that intermediation can be positive. But a slowing growth in the U.S. economy is certainly going to be negative for lending and for banking activity.
Thank you. And the next question is, do you think that the USA will have another Weimar Republic like Germany had in the 1920s, with all the similar issues going on in the USA banking system run by privately owned Fed Reserve?
So this is total speculation. I don't have data on this, but I think the answer is no. What you had in the 1930s in Germany was a country that was still reeling from the costs of a devastating war, World War I, and a global depression, and a government that was very much fractured. And so it was very much a different situation. One thing to keep in mind, though we're talking about international trade and the importance of international trade, is actually for the U.S. not a huge part of economic activity, because the U.S. economy is very large and is kind of self-sustaining with or without international trade. It'll be smaller, there'll be less higher prices and less variety with less international trade, but it is a huge market and one that's very diverse. And this is really, turning back to China. This is really what the Chinese government is looking at for the Chinese economy. It's a huge economy. It could be self-sustaining. How do they get there?
The next question is, I read that some trading partners are implementing retaliatory tariffs on imports from red states. How does this change the outlook?
I think that's incorporated in the outlook, and it's not only red states. For example, California is a major exporter of wine, and we're seeing retaliatory tariffs against wine. California is a major exporter of rice and of fruits and nuts, and we're seeing retaliatory tariffs against those. We are seeing restrictions on the importation of technologies, which impacts the Bay Area in particular. China has just put a hold on the importation of aircraft from Boeing. Admittedly, those are made in Washington State, but they contain components that are made in Southern California. So California is very much a blue state, and these retaliatory tariffs are going to have a profound impact here in California. Maybe proportionately more in Kentucky and Tennessee and Iowa, but it will be felt here as well.
Thank you. And the next question is, how does inflation play into all of these in regards to salaries and income to inflation?
The important thing about those inflation expectations becoming unmoored is that the workforce in the US is going to demand higher wages because they expect their wages to be the purchasing power of their wages to be diminished by this expected inflation. And so in order to get workers, firms are going to have to pay more, and that is just going to feed into more inflation. The shortage of labor as well is going to feed into more inflation. So this is, I think, going to be the big worry on the part of the Federal Reserve, that we are possibly on the cusp of a wage price spiral, one that's going to really take a recession to squeeze out of the economy.
And the next question is, will the house prices go up or down? And do you think the increase in tariff is good for U.S. economy in the long run?
Okay, so the first one, will house prices go up or down? The answer is up. The U.S. doesn't have enough housing. In some places, there's plenty of housing. Youngstown, Ohio, Phoenix, Arizona, but in the aggregate, the U.S. doesn't have enough housing, so home prices are going to go up, particularly here in California, but elsewhere as well. And then the second part of the question, I'm sorry.
Do you think the increase in tariff is good for U.S. Economy in the long run?
So this is, really a political decision of what you want the U.S. economy to look like. And some of these tariffs that will bring back manufacturing to the U.S. It won't be manufacturing like we saw before with metal bending and riveting. It'll be advanced manufacturing. Is probably good for the U.S. National security things, bringing back healthcare. If we remember in the first part of the COVID pandemic, there was a shortage of protective devices because they were manufactured in China and they were being flown in on cargo aircraft. Well, you probably do want to make things that are critical for your economy domestically, or at least with very friendly partners, not necessarily adversarial partners or partners that you think are adversarial. And you may want the economy to have, say, more manufacturing, and so tariffs might achieve that. And if that is the social goal, the political goal, then in the long run they can have that effect. They don't necessarily have a good effect in the long run, but they can. So it depends on the goal. And I think the real issue today is that we don't have clarity as to what the goal of these tariffs are.